Is Forex trading gambling? Forex trading is frequently compared to gambling. This is because both activities involve risking money under uncertain conditions. A person who places a bet in casino doesn't know whether they will win. In the same way, a trader cannot know whether a current price will rise or fall 100% certain. No, in both cases, money can be gained quickly, but it can also be lost. This similarity has led people to conclude that Forex trading is simply another form of gambling. However, uncertainty alone does not make an activity gambling. Starting with business, it involves uncertainty. Buying a house involves uncertainty. Investing in education, it involves uncertainty. Even making medical decisions can involve uncertain outcomes. So in this video, I'm going to explain the real difference between Forex trading and gambling in the casino or anywhere else. And I hope that by the end of this video, you will know exactly what Forex trading is and how it fundamentally differs from gambling. I have broken this video into 4 sections. Section 1, we will understand the contemporary Forex trading and how it is done. Section 2, we will understand gambling and all of its characteristics. Section 3, the difference, and I'm going to show you how these differ as a direct side-by-side comparison, so that for every single point about gambling, you immediately see how Forex trading compares, not getting lost, not getting confused. And then Section 4, I will tell you the 12 characteristics that a profitable Forex trader should have. And before we go into Section 1, please drop a comment section right now telling me which of these 12 characteristics that will resonate with you or you are trying to build on right now. Let's get into the video. Section 1. What is Forex trading? Forex, or foreign exchange, it is the buying and selling of currencies against each other on the global financial market. And when I say global, I mean truly global. It is the largest market in the world. $7.5 trillion traded every single day, more than all the world's stock market combined in a single day. It runs 24 hours a day, 5 days a week, across every time zone on Earth. In Forex, you trade currency pairs. You buy one currency pair, you buy one currency using another currency. Take the euro against the US dollar, for example. If you believe that the euro will strengthen against the dollar, you buy it. If it rises, you are in profit. If you believe that the euro will weaken, you will sell. If it falls, you profit from that direction instead. You can profit going up or going downward. The falling market is simply a different opportunity. The most traded pairs in the world all involve the US dollars. The euro against the dollar, the British pound against the dollar against the Japanese yen, the Australian dollar against the US dollar, the Canadian dollar against the US dollar, and then there is gold priced in the US dollars. One of the most closely watched assets in the world because it reflects the global confidence, fear, and trust in the financial system. The market runs from top-down system. At the very top, we find the central banks, like the Federal Reserve, the European Central Bank, the Bank of Japan. These institutions, they control interest rates and move currencies instantly with their decisions. Below them, we have the commercial banks, like the Goldman Sachs, JP Morgan, the Barclays, and then the hedge funds and institutional investors. Then we have the corporations like Apple, Toyota, converting international revenue and paying suppliers in foreign currencies. And at the bottom, there are the retail traders, individuals like you and me. We are the smallest participants, but because of technology, we access the same market, the same prices, and the same opportunities. What moves the currency pairs? Real economic forces, interest rates, inflation, employment, economic growth, geopolitics, market sentiments. Every one of these is trackable and analyzable, and it's also predictable to an educated trader. And that's the foundation. That's why Forex is not gambling, and we are about to prove it point by point. Gambling versus Forex trading. For every point about gambling, I'm immediately giving you the Forex equivalent. Let's start with point number 1, the mathematical edge. In gambling, the house always holds a built-in mathematical advantage. It exists in every single game before you press your first bet. For example, in roulette, for every $100 you wager, the casino is mathematically guaranteed to keep more than $5. Every spin, every bet, and every session, also every time. Here, the strategy doesn't stand a chance. There is no strategy that can change this. The longer you play, the more it destroys your capital. In Forex trading, however, there is no built-in edge against you. The only cost is the spread, which is a small transaction fee between the buying price and the selling price. More importantly, a skilled trader builds a genuine positive edge through their strategy. A strategy that wins more than half the time, where winning trades can earn twice what the losing trades cost, is mathematically profitable over time. And that flexibility does not exist in gambling. In gambling, the edge is fixed against you, whereas in Forex, the edge is something that you build with the skill set that you have. Point number 2, let's take a look at the role of chance. In gambling, pure and uncontrollable chance. A roulette wheel has no memory. The ball doesn't know or care that the red came up 10 times in a row. There is no information in the world, no data, no research, no system that can tell you where the ball lands next. In a random system, knowledge is worthless. In Forex trading, there is cause and effect. We don't have chance. When the Federal Reserve raises interest rates, the dollar strengthens every time. When inflation surprises high, gold rises. When jobs data is weak, the currency falls. In Forex, information has a genuine predictive value. In gambling, information changes nothing. In Forex, information is everything. Point number 3, control over your money. In gambling, once you bet, there is zero control. The wheel spins, you cannot reduce your loss, you cannot exit early, you cannot pause and recess. Your money is completely out of your hands until the event ends. In Forex trading, however, there is total control. Before you enter a trade, you set your stop loss. The maximum you can lose defined before you even click enter. You set the take profit, where the trade closes automatically with your gains. You size your position mathematically, and at any moment during the market hours, you can exit instantly. In gambling, your money leaves your hands when you bet. In Forex, it never does. Point number 4, the role of the skill. In gambling, the skill is irrelevant. You cannot study your way to predict a dice roll. No experience that makes you better at slot machine. And when someone does find an edge, like card counting or in a blackjack, the casino bans them immediately. The casino responds to winners. It removes them from the game. In Forex trading, skill measurably improves the outcome over time. Renaissance Technology is one of the world's greatest trading firms, average over 60% annual returns for 30 consecutive years using mathematical trading models. 30 years, 60% per year. That doesn't happen in a random system. In gambling, winners get removed, and in Forex, winners get more capital. Let's check point number 5. What sets the price? In gambling, a random number generates a board, a shuffled deck. The outcome has no connection to the real world. No economics, no human behavior, no cause you can study. It's just what it is. In Forex trading, real supply and demand from millions of participants worldwide, responding to real economic conditions. Interest rates, inflation, political instability, trade imbalances, currency prices are the world's real-time expression of the economic reality. Every price move has a cause, and the skilled trader learned to read these causes. Let's talk about point number 6, which is risk management. And it's the most differentiating factor. In gambling, professional risk management doesn't exist. You choose your bet size and that's all. Strategies like doubling your bet after every loss accelerate your ruin. They don't prevent it. No framework overcomes a negative expected outcome. In Forex trading, however, there is a complete mathematically grounded discipline. Professional traders risk only 1 or 2% of their account on a single trade. At that level, they can lose 50 consecutive trades and still keep over 60% of their capital. They calculate exact position size before every entry. They use professional tools, position sizing formulas, drawdown limits, and expected value calculations. Risk management is what determines whether you survive long enough to become profitable. Let's talk about psychology and the environment, because this will be the differentiating factor also. In casino, which is also part of gambling, they are psychological machines. No clocks, no natural light, constant noise and stimulations, near misses where you almost win, and deliberately program you into a slot machine to keep playing. Free drinks, lower your judgment. The anticipation of possibly winning triggers the same neurological response as a certain addictive substance. The World Health Organization classifies this problem gambling as a behavior addiction. The casino environment is designed to keep you spending, not to help you win. In Forex, you control your own environment entirely. Your workspace, your hours, your rules. There is no engineered manipulation pulling you towards a bad decision. The psychological danger comes from within. The fear, the greed, the impatience, and all of those are trainable. Professional traders journal their emotional state. They set daily loss limits. They follow a written plan. Whereas in gambling, the environment exploits all your psychology. In Forex, you master it. Let's look at the long-term outcome. In gambling, loss of capital, mathematically inevitable over time. No gambler beats the house edge game over the long run, none. And the rare ones who find an edge, they get banned. In Forex trading, consistent positive results for traders with genuine edge and discipline, like George Soros, who made $1 billion trading currencies in a single day, Paul Todo Jones, Ray Dalio of Renaissance Technologies. Thousands of professional traders worldwide are paid specifically because they produce consistent returns. Profitable traders are not removed, they are promoted. They are given more capital. They are sought after. In gambling, consistent winners, they get banned. In Forex, consistent winners, they get rewarded. Every single time, the comparison reveals the same truth. These are not similar activities with surface difference. No, there are fundamental structures and mathematical differences. But I want to say one thing directly. When you trade without a strategy, without a stop loss, without a plan, you are automatically gambling. And the market will treat you exactly like casino treats someone who does not understand the odds. The market is the same for everyone. What is different is who you are when you are down in front of the market. Let's talk about the 12 characteristics a profitable trader should have, or what shows that you're a profitable trader. Drop a comment. Which one are you working on right now? Number 1, they trade with a written plan, not an impulse. They have entry rules, they have exit rules, risk rules, all written before they touch the market. Every trade follows the plan, not the feeling. A gambler reacts and the trader executes. Point number 2, they make risk management first. Risk management is their first priority. They never risk more than they can afford to lose. Better 1 to 2% of their account size in a single trade. A stop loss on every single trade. They are never one trade away from a disaster. Point number 3, they think in probabilities, not certainties. Not this trade will work, but over many trades, this strategy favors me. They run a probability machine, not a single bot. They keep a trading journal. Every time they record, and every trade is always recorded. The entry, the exit, the reason, the emotion, and the lesson learned after taking it. The journal reveals the patterns invisible in the moment. It is their most powerful improvement tool. Number 5, they are disciplined with losses. When stop losses get hit, they close the trade immediately without hesitation. They don't move the stop loss, not adding money to a losing trade. They accept the loss as a business cost. And this characteristic separates almost everyone who loses from the one who wins. Rule number 6, they are very patient. They can watch charts all day and take 0 trade and feel the action about it. Missing good trade is better than taking a bad one. Patience is a competitive edge. Point number 7, they control their emotions. They don't trade angry. They don't trade tired. They don't trade immediately after a big win or a big loss. Fear, greed, impatience are identifiable triggers. With a system in place to stop them becoming decisions, that's what keeps them profitable. Point number 8, they never stop learning. Markets evolve. A strategy that worked 5 years ago may need to be adjusted for today. They always study, they always review, they ask hard questions about every move the market makes. Trading is a lifelong craft. Then number 9, they have a tested, genuine edge. They can describe it simply, back-tested, forward-tested, and they have real data. They don't follow tips or signals that they don't understand. They trade a proven, repeatable process. Point number 10, they respect the market. They never believe that they have fully figured it out. No, they have humility in every session. They are never arrogant after wins, never devastated after losses. They are even grounded professionals. Point number 11, they separate their identity from the trades. After a loss, they don't make them. A loss doesn't make them a failure. No, a win doesn't make them a genius. One question only, that's what they ask themselves. Did I follow my plan? Yes, that was a success. If it's no, that was a lesson. They do this process over and over, and they do it always. Point number 12, they are very consistent. Everything in characteristics 1 through 11, every single day, not when they feel like it, not only when the market cooperates. They do it every day because consistency applies at a genuine edge. Over 100 trades is what turns this into something truly life-changing. A gambler looks for the lucky bet. A professional trader builds an engine, and then they run that engine with discipline, with patience, and with consistency until the mathematics do the work for them. So, is Forex trading gambling? Without knowledge, without plan, without risk management, and without discipline? Yes, the market treats you exactly like a casino. How it treats someone who doesn't understand the odds. But with those things right, you are not gambling. You are operating a skill based on business. In the world's largest, most liquid financial market, the market is in the same position, same condition, everyone who opens a chart. What is the difference? The difference is who you are when you sit down in front of it. So tell me, which one of the 12 characteristics you are working on right now? Drop them in the comment section below. And if this gave you value, share it with someone who needs to hear it today. Subscribe for more, and I'll see you in the next one.